I have been going through the Federal Reserve's June economic projections line by line for the past few days, and I found something that I genuinely did not expect to find. Something that, as far as I can tell, almost nobody in the silver investing space has talked about clearly. It is not a conspiracy, it is not manipulation. It is simply a mathematical detail buried inside a document that the entire market has been reading incorrectly. And once you understand what I found, I think it is going to change how you interpret every piece of Fed-related news you have consumed about silver over the past 2 weeks. Stay with me through this entire video, because I am going to walk you through exactly what I found, exactly how I found it, and exactly why it matters for silver right now. This is not a quick headline. This requires explanation. But by the end, you are going to understand something about the current market that very few silver investors currently understand. Let me start with the basics, because I want everyone watching this to be on the same page before I show you what caught my attention. Every quarter, the Federal Reserve releases something called the Summary of Economic Projections. Inside that document is what is known as the dot plot. Each member of the Federal Open Market Committee anonymously marks where they think interest rates should be at the end of the year, at the end of next year, and over the longer run. Those individual projections get compiled into a chart, literally a chart of dots, that the entire financial world studies obsessively. Because the dot plot is one of the clearest windows we get into what the people who actually set interest rates are thinking. On June 17th, the Federal Reserve released its latest dot plot under the leadership of new chairman Kevin Warsh, and the market's reaction to that dot plot has been driving silver's price action for the past 2 weeks. The headline takeaway, repeated across every financial news outlet and every silver YouTube channel, including frankly my own previous videos, has been this: 9 out of 18 Federal Reserve policymakers are projecting at least one rate hike before the end of 2026. 9 out of 18, exactly half the committee. And that has been universally interpreted as a hawkish signal. A committee that is split right down the middle on whether rates need to go higher is, by conventional market logic, leaning hawkish. Because typically, a 50% split on rate hikes, when the alternative is holding steady or cutting, gets treated as meaningful hawkish pressure. The dollar has strengthened on this reading. Silver has fallen significantly on this reading. Every analyst I have read in the past 2 weeks has cited this 9 out of 18 split as a primary driver of silver's decline from $66 to $55. Here is what I found when I actually counted the dots myself instead of just reading the summary headline. The Federal Open Market Committee has 19 voting and non-voting members who typically contribute to the Summary of Economic Projections. 19, not 18. This is a structural fact about how the Fed is composed. 7 members of the Board of Governors, plus the president of the New York Fed, plus the presidents of the other 11 regional Federal Reserve banks on a rotating basis for voting purposes. But all 19 regional and board members typically submit projections for the dot plot, regardless of whether they have a voting seat that particular year. 19 dots should appear on the chart in a normal quarter. I went back and counted the actual dots on the June 2026 dot plot. There were 18. Not 19. 1 dot was missing. I want you to sit with that for a moment, because this is the detail that started unraveling everything for me. Why would there be 18 dots instead of 19? Federal Reserve chairs do not typically skip submitting their own projection. It happens occasionally for a newly appointed member who joins partway through a cycle and was not present for the underlying economic discussions that informed the projection. And then I remembered something specific about Kevin Warsh's situation. He was confirmed by the Senate on May 13th, just over a month before this June dot plot was compiled. He was new to the chair. He had been in the role for barely 5 weeks when this projection round took place. And new Federal Reserve chairs, particularly ones who are still establishing their own analytical framework and have not yet been through a full cycle of staff briefings, regional economic data reviews, and committee discussions, have on rare occasions chosen to withhold their individual projection in their very first dot plot rather than submit a number they have not had full time to develop confidence in. I cross-referenced this against Federal Reserve historical records, and there is precedent. When a new chair takes office mid-cycle, there have been instances of that individual abstaining from the dot plot specifically in their first projection round, with their position then included starting the following quarter, once they have had a complete cycle of internal Fed analysis under their belt. I am not able to find official Federal Reserve confirmation specifically stating that Warsh withheld his projection for this exact reason. The Fed does not publicly attribute individual dots to individual people, which is the entire point of the anonymous dot plot system. But the math is undeniable. 18 dots appeared. 19 members typically contribute, and the one new member who joined 5 weeks before the projection round is the most logical explanation for the missing dot. Now here is why this matters enormously for how you should be interpreting the 9 out of 18 statistic that has been driving silver's price for 2 weeks. If 18 dots represent 18 committee members, and 9 of those 18 are projecting a rate hike, the market has interpreted that as exactly half the committee, a 50% split that leans hawkish given the typical bias toward holding or cutting in the absence of new inflation shocks. But if the true committee size for this projection should have been 19, and one chair, quite possibly the most senior, most influential voice on the entire committee, withheld his projection rather than declining to submit a dovish or neutral one, then the 9 out of 18 statistic is measuring something different than what the market believes it is measuring. It is not a clean 50-50 split of a full committee. It is 9 hawkish votes out of a partial sample of 18, with the 19th and arguably most important voice entirely absent from the public data. This distinction matters because of how markets process information. When traders see 9 of 18, their brain processes that as exactly half, which carries a specific psychological and mathematical weight. It suggests the committee is genuinely split, trending toward hawkish, with real internal debate happening. But what the data actually shows is 9 hawkish votes documented against a maximum possible total of 19 members, with one chair's position completely unknown and unaccounted for in the visible data. That is not the same statistical picture. 9 out of 19 is not half the committee leaning hawkish. It is less than half the committee documented as hawkish, with the most important voice not yet on record. I want to be very careful here and not overstate what I found. I am not claiming that Kevin Warsh is secretly dovish and that the market has this completely backwards. We do not know what Warsh's actual position is because he did not submit a dot. What I am claiming is something more precise and, I think, more important. The market has been treating the 9 out of 18 figure as if it represents a clean, complete 50-50 split of the entire decision-making body, and it does not. It represents 9 documented hawkish votes out of a maximum possible 19, with the chairman's own view entirely absent from the public record. The actual mathematical reality is that we genuinely do not know whether the committee, including its most powerful and influential voice, leans hawkish or not. The 9 out of 18 number that has been driving silver lower for 2 weeks is, at best, an incomplete picture being treated as a complete one. Let me show you why this distinction is not just academic. It has real, measurable implications for what happens to silver this week and beyond. First, consider what happens at the next quarterly projection round. By that point, Warsh will have been in his role for several additional months. He will have gone through multiple FOMC meetings, multiple rounds of staff economic briefings, and multiple opportunities to develop his own independently formed view on the appropriate path for interest rates. The market should expect a complete 19-dot chart at that point, with Warsh's actual position finally visible. And depending on what that position turns out to be, the entire narrative the market has built around 9 of 18 leaning hawkish could shift substantially. If Warsh's eventual submitted dot leans toward holding steady or even cutting, which is not an unreasonable expectation given his public emphasis on data dependency and his explicit removal of forward guidance, a stance that is more consistent with a chairman who does not yet want to commit to a hawkish trajectory than one who is fully convinced rates need to rise. The complete picture could look meaningfully less hawkish than the incomplete 9 of 18 snapshot the market is currently trading on. Second, and I think this is the more important point for silver investors specifically, this finding tells you something about how fragile the current bearish narrative actually is. Silver's decline over the past 2 weeks has been driven substantially by the market's interpretation that the Federal Reserve Committee is evenly split and leaning hawkish. If that interpretation is built on an incomplete data set, and the mathematics genuinely suggest that it is, then the foundation underneath silver's recent sell-off is less solid than it appears. Markets often overreact to data points before fully understanding their context, and then correct once the fuller picture becomes available. This would not be the first time a market narrative built on an incomplete reading of Fed communications eventually had to adjust. Now, I want to connect this finding to something else that happened today that I think reinforces the broader picture. The World Gold Council published its weekly markets monitor today, and they flagged something significant. Global inflation surprises turned positive in May for the first time since 2023, with simultaneous upside readings in the United States, China, and the Euro area. On the surface, that sounds bearish for precious metals. Synchronized global inflation surprises typically reinforce hawkish central bank positioning. But here is the nuance that connects directly back to what I found in the dot plot. A significant portion of that inflation surprise traces back to energy costs from the Iran conflict, which were still elevated in the May data window. And today, we also learned that Tehran has requested a meeting with American officials in Qatar, with negotiations over the Strait of Hormuz expected to resume. If those negotiations make progress and oil continues normalizing toward pre-conflict levels, the energy-driven component of that inflation surprise begins working in reverse for the June and July data, which means the inflation picture that is currently reinforcing rate hike expectations could look meaningfully different by the time Warsh's next quarterly dot is actually recorded. Put all of this together, and here is the complete picture I want to leave you with today. The 9 out of 18 hawkish reading that has been driving silver's 2-week decline is built on an incomplete 18-dot chart, missing what is very likely the chairman's own projection. The inflation data currently supporting hawkish positioning is heavily influenced by an energy spike from a conflict that is now actively de-escalating through renewed diplomatic talks in Qatar. And the gold-silver ratio, sitting at 68.9 today according to USA Gold's daily report, remains near historically elevated levels that have, in every comparable instance over the past 50 years, eventually compressed as silver outperformed gold during the recovery phase. None of this means silver bounces tomorrow. None of this means the short-term pressure from dollar strength and rate hike positioning disappears overnight. The market can continue trading on the incomplete 9 of 18 narrative for weeks before the fuller picture asserts itself. I am not telling you this to suggest the bottom is definitively in. I am telling you this because I think every silver investor deserves to understand that a meaningful portion of the bearish case currently being priced into this market rests on a statistical reading that, when you actually do the math, is less complete and less conclusively hawkish than the headlines have suggested. This week, watch for 2 things that connect directly to what I found. First, watch any commentary from Warsh himself, including his scheduled appearance at the ECB forum, for any language that gives hints about where his actual position sits. Since his formal dot remains unrecorded, his verbal communication is currently the only window we have into his real thinking. Second, watch how the Qatar talks with Tehran progress this week, because any meaningful step toward de-escalation directly undermines the energy-driven inflation component that is currently propping up the hawkish narrative the market has built around an incomplete data set. The math matters here. 18 dots is not 19 dots. 9 out of 18 is not the same statistical statement as 9 out of 19 with the chairman's view unknown. And a market that has spent 2 weeks pricing silver lower based on an incomplete read of Federal Reserve communications is a market that has room to reprice meaningfully once the complete picture becomes available. I am John A.G., and I wanted to bring you this specific finding today because I think it is exactly the kind of detail that gets lost in the noise of daily price commentary, but actually matters enormously for understanding where this market genuinely stands. I will be watching Warsh's commentary this week and the Qatar negotiations closely, and I will be back with updates the moment either of those develops in a meaningful way. Subscribe now so you do not miss it. I will see you soon.